We have talked about a lot of issues today, not least of all, of course, that discussion that we've just been hearing. And we'll pick up some of the themes in that discussion in this conversation, because we're now going to talk to the actual investors, the people who make the decisions about where the money goes and arguably probably have less sleep than any of us. It is a volatile time, which I'm sure all three of our panel members today are going to say is just par for the course. But there is a sense, as we were saying earlier, that the world order is fundamentally challenged and that the impacts could be profound, although incredibly difficult to predict. And if you think about whether it's AI and business models or tariffs and supply chains or global powers and that international order. So what does keep our investors up at night, and how do they see their role as active stewards of capital? So please welcome for the panel Vicky Doyle, Chief Executive Officer of Rest Super, John Pearce, Chief Investment Officer at UniSuper, and Sonia Sortel-Rixon, who's CIO at Hester. Please welcome our panel. I will get to environment to follow up on that conversation that we were just listening to, but if I can start with you, Vicky, just on the big picture, how do you read and how do you navigate the current geopolitical landscape? And we only have a limited number of minutes for that conversation, because I think we could have a long one.
Thanks, Ali. Well, I might set some broad context in terms of that geopolitical, what keeps us up at night. And I think from my perspective as sort of the steward of capital for our members, that's a really important role. And so if I use Rest as an example, we've got 2 million members, and 1 million of those are under 30. So 1 in 5 Australians under 30 have their savings with us. And so whilst we might be considering what are all the short-term issues of the geopolitical, and I'm sure we'll get to that, my broader thought is that many of our members won't retire until 2060 and 2075. And like the previous comment, the question that keeps us up is, what world will they retire in? We are planning their retirement income, taking their money today, giving it back to them in 40 years' time, in a world that is yet to be defined. And so I guess what we try to think about is, how do we best use that money in this short-term environment, but not lose focus on actually decarbonisation, thinking about those bigger thematics of the world we're actually creating. Because for us to invest and just make good short-term returns or work through all the volatility and the geopolitical, my view is that if we're really holding on to capital over many decades, we need to stay very focused on those long-term themes. So that's, I think, a great responsibility, and the previous panel mentioned that, which is there's a lot of difficulty in the short-term political environment. Geopolitics creates investor uncertainty, it creates lack of confidence. Our members are reacting to that and ringing us and saying, I need to protect myself against Trump. Can I just put my money on hold and not invest at all for a while? That's what one member asked. And so we've got to react to those short-term aspects, but we've got to think really significantly about the long-term.
And I will come back to this, because there's an obvious follow-up there, in that it's all very well to think of this as short-term, but if it becomes structural, then what are we building in for a longer term? But before we do that, Johnny, I heard this phrase yesterday and I thought it was very good. Are you like a cat in a hot tin roof waiting for tariffs tonight?
Yeah, look, I must say there's a lot of nervousness in the market at the moment, and it's not the normal sort of nervousness. If you think about the difference between a 10% correction, which is actually a healthy thing, and particularly if you're on accumulation, you want 10% corrections, but the difference between a 10% correction and a 30% collapse is the US going into recession. And the things are really rolling over in the US at the moment, so we're waiting with bated breath, because if what's delivered tonight, we don't expect it's going to be the final word, of course, actually accelerates that path to recession, we could be looking at a much uglier picture in markets.
But do you have to look at what happens tonight or in the morning and sit tight and just watch?
Yeah, look, it's nice to sit back and think that we take long-term views on things, etc. And I agree with Vicky. We do have to look long-term. But the reality is long-term is comprised of lots of short-terms, right? It's all well and good us looking at the long term, but we've got a massive cohort that are in retirement phase at the moment. And I tell you what, they don't really care that much about what's happening in 5 or 10 years' time. They're looking at their balances on a weekly, sometimes daily basis. So we have to feel their pain as well.
As one of your members very close to retirement age, I'm with them, so I know where they're coming from. Sonia, can I ask you, how do you read the current environment and how do you respond to it?
Yeah, look, I think we're in an environment at the moment that is probably one of the most fragile we've had for decades. I think we're seeing trade relationships changing before our eyes. We're seeing security relationships changing, and we know those two things are also somewhat interdependent. When we're thinking about how to respond to that challenge, the US obviously is still the deepest and most significant capital market in the world, and I think this is where it creates quite a unique challenge for investors because, when we've had other missteps or other challenges in the past, they've tended to be in small emerging markets where it's been small exposures in the portfolio and small challenges to address. I think standing here today, as long-term investors, what we really need is stability. We need stable political environments, we need stable legal frameworks and rule of law. We benefit from international collaborations and agreements, and we're seeing a lot of those traditional things being challenged in some very significant developed markets. I think, on top of that, we're all trying to address systemic risks such as climate, which we know are very real financial risks that if we don't transition effectively, we're going to be faced with much more material physical risks. And yet we know that some of these things are being downweighted, and the momentum is maybe slowing a little bit in the short term, which means the consequences in the medium and long term may be larger. So, when I think about what keeps me awake at night, it's probably just how do we continue to invest our capital to through this uncertainty, but also to try and help build stability into the future.
Because bottom line, you don't have a choice with the US market, you have to play in it, don't you? And I found it interesting that Australian Super, I think, was the one who has sold out of Tesla. I don't know, or maybe I've got the wrong, whatever, one of the big super funds has sold out of Tesla. But and they sold out of WiseTech in this environment. But I'm curious about that. Do you respond at that level? Like, at what point do you put the values of what you do against where you invest? And it's a different conversation when we come to maybe decarbonisation, but I'm talking now about the politics of it. Can I put that to you, Sonia?
Yeah, look, obviously when we think about where we put our capital, we're thinking about many elements. Some are broad beta elements about where do we want to access market returns, and some are more targeted thematics where we want to benefit from particular tailwinds. Obviously our exclusion list, and then we have an escalation framework which allows us to call out particular companies where we do think the current behaviours and the current decarbonisation pathways are really at odds with the values of our members and the financial interests of our members. But it's a very wide world, and making sure that we're focusing on the things that are most material for our members continues to be quite important.
And to go back, Vicky, to that initial point about the long-term horizon that you have, but the world that might be there at the other end, it must be incredibly difficult to sit back and think, well, when is this something that is going to change the longer term, and when is it something that is going to be just for a period? It's going to be a blip ultimately.
I think it is, but the way that we look at it, and the previous panel talked about the mega trends, and so I think everyone has a different way of characterising them, but we call them the 5 Ds, and we think those investment opportunities, so there's lots you have to do in a tactical and a DAA type methodologies day to day, but at a broader level, those 5 long-term deglobalisation, demographic changes and longevity and life and health that we talked about before, digitalisation, so we'll talk about, I'm sure, AI in a moment, and a few other of those, debt around the world, etc. that's what guides us to look for opportunities. And so whilst you're managing today's world, you do need to make some bets, to Sonia's point, on some longer term investments. So for example, Quinbrook is an investment that is focused on data centres and supporting AI in the future. And we make a meaningful allocation to that of $1 billion, and that's about creating new data centres in a new market in north of Queensland, which also hits our ESG requirements and thinking about infrastructure for the future for this world that our members are going to retire into. So it is a balance, to John's point. We can't go all long term, but I think you need those thematics to make sure that you do have some structure, because there certainly will be some misses, and that is investing. There is risk in investing on all fronts.
So if I can play devil's advocate a bit, John, we've just been hearing about 1.5, the role of investors in that as well. But you're all committed to decarbonisation. You've got an America that's withdrawn from Paris. It's all drill, baby, drill. What if they water down the IRA? What if there are major changes coming out of the US? I don't know, maybe they'll be overturned in a couple of years' time. But what does that do to the decarbonisation imperative of UniSuper?
Nothing at this stage in terms of our changes. And bear in mind that Trump pulled out of Paris once before, right? And corporate America just went headlong and kept on the decarbonisation path. So is corporate America going to do anything differently today because Trump's pulling out? I don't know. The jury's out. Look, decarbonisation is such a compelling thematic, right? That we're going to stick with it. The question is where you place your chips. That's to me a much tougher question. So what we're grappling with is exactly that. And the economics, a lot of aspects of renewable energy just don't stack up with us at the moment. So it's got nothing to do with Trump pulling out of Paris, etc. But we're not going anywhere near hydrogen, we're not going anywhere near nuclear or offshore wind, because the economics just don't stack up, regardless of Paris.
So the geopolitics has got nothing to do with that?
Nothing at all to do with it, right? We've got to all accept too that even before Trump came in, there was a change in the dialogue, the narrative around energy transition. 2-3 years ago, it was all about clean energy. Today, it's equal. Clean energy, we all want that, but there's energy security and energy affordability as well. And that's something that we have to take into account.
So just in the same vein, and I promise I won't talk about Trump for the next half an hour, but Sonia, just on that, we were talking about EI earlier today. You've got investor partners. What do you do in the current environment? And we know the influence and the impact that that's having on educational institutions, for example, even in Australia. How do you approach that and ensure that it doesn't bleed into what you do here?
Yeah, look, DEI is a focus of ours for a number of reasons. Obviously, we represent 80% female membership, so it matters for our members. But it matters for great investment decision making. Like, we know that more diverse boards and more diverse management make better decisions, manage risk more effectively, and generate stronger performance. So we care about this. We undertake reviews of our managers regularly, every 2 years, and specifically in the investment value chain, trying to assess what they're doing and get a lot more data capture and insight into their DEI policies and actions. And it's interesting. We've just released. We're just in the process of finalising our next one, and again, we're seeing progress. So even in the current environment, we're seeing managers continuing to improve diversity. We're seeing managers continuing to invest. I think they're getting a little more nuanced, and as we're engaging with them, definitely getting a bit more nuanced in how they talk about it. They talk about inclusivity now.
So they've changed their language.
Instead of diversity, yeah. But still very much committed to the direction. But I think just trying to buy themselves a little bit of headroom, given the complex environment they're operating in.
You mentioned before, Vicky, about what at least one of your members is doing, but the fact that they are ringing you. What do they care about in the current environment?
Well, I got a few statistics on it because I thought we would talk about this, and you're right, John has highlighted, it's mostly our close to retirement members. So although we've got a significant amount under 30, we have a significant amount who are retiring. And in mid-March, in a space of a couple of days, we had more, than 700 additional calls than we might normally have. And just the insight around that is the members really wanted advice on how to move to less risky, and they were thinking about cash. Some felt concerned about the volatility would impact their retirement savings, and we saw that through GFC and previous periods. People then have to extend their retirement plans, so it becomes incredibly real. Volatility like this, and very concerning. And particularly, we've got more than 1 million members on our app, so they get to see every day, every minute when it's going up and down. That's a great engagement tool, but in today's volatile world, it can create anxiety. And then the last one, as I said, wanted, the members' words were actually that in this volatility, they wanted to Trump-proof their super. And how could they do that? And as I said, another one said, I just want to actually put my investments on hold. That's the first time I've actually heard that language. I want to put it on hold. Do I have to take my money out for that? Or can I just go on hold and be in nothing? And so, it's our role and it's their money to make sure that they feel secure through that, but you can't communicate with everyone at all times. So the volatility period is very concerning for people who are getting closer to that retirement, and it means very real impacts on whether they will work longer, can pay down debts, and all the difficult choices that they're coming up to.
Does it change how a member views your values, if you like, your commitment in terms of your longer term investment strategy?
I think there are differences in segments for sure. I think certainly younger generations, well, our overall statistic is 86% of REST members, so the 2 million, and they go for anything from 15-year-olds to 91. 86% expect us to invest responsibly and think about sustainability. I think there are differences when you get closer to retirement. I think there's still an interest because they're not thinking necessarily about themselves, they're thinking about generations of their grandchildren and others. And I think more and more it's just become standard to be talking about the world we're in and where is the world going. It's changing before our very eyes. It's not just about me and my retirement, it's actually about my grandchildren. So I'm seeing that a few years ago, it was much more polarised. I would say everyone has a collective view, but a different intensity on that.
John, are you finding that your members are moving?
Not panic stations yet. Obviously, we're seeing a shift, switching from growth options to cash, but it's a trickle more than a flood at the moment. And look, I'd like to think that it's because they've become a bit more educated and seen that the experience of switching, and panicking at the worst time, they've left a lot on the table. COVID wasn't that long ago when a lot of this happened, and I'm sure people have missed out on the big bounce back. So I'm hoping that that's the case. But look, let's see how much their patience is tested. If the markets are down another 10%, that trickle could actually turn into a flood.
What are you seeing, Sonia?
Very similar. We tend not to get, even at the extreme, like even in extreme markets, and I don't know what your numbers are, John, but we're definitely below 5%, I'd say, maybe 3-ish. And at the moment, we're probably seeing about 0.5% of switching, so it's quite low in terms of the active members. I do find, interestingly, just a behavioural anomaly, that if we start the financial year and markets draw straight down, so we're printing negative returns, it actually generates more action than if you go up first and then go down. So even if you effectively have the same drawdown, but if it's still a positive number, there's less activity. So there's some really interesting behavioural things that come through as well in the membership.
I will get to questions, so don't forget to send your questions through via Slido. But I want to ask you, we had a conversation earlier today with the head of ASIC regarding their inquiry into the shrinking public markets and the growing private markets. I'm curious as to how you think that will affect superannuation funds and what you think is driving that movement. Vicky, do you have a view on that?
I think my answer to that, Ali, would be that it's quite a broad answer, but private and public markets are really important for diversification and they're really important for returns. And I think, rightly so, the regulator's job is to try to find issues in a system that we may not be aware of. And so I don't think it's unreasonable for the regulator to be considering the transparency around public markets. It's easy to see ESG is well and truly integrated into those public markets. It's not as easy to see from a private markets perspective, but private markets is getting there. And but it's incredible. So I think it's right to ask that. My view would be there's a transparency concern for regulators, and then secondly, it's also about how that transparency issue might lead to, in a volatile environment, liquidity issues.
But do you think they're fair concerns because you all play in that space?
Yeah, I think a regulator, if they feel like there isn't transparency or there could be systemic liquidity issues in this globally, crazy world, then what else is a regulator's role but to look at systemic risks? It's our job to say we have the frameworks in place and this is how we go about it, to communicate that actually we have good structures. And so my example on that would be in early release of super, through COVID period, markets were really difficult at that period. We had a policy that came in that required significant cash for early release of super in risk, and that was a 4 weeks notice period we were given. And all of the funds did really well through that period. They already had strategic asset allocations, frameworks for liquidity. Every day our job is to think about that, including testing scenarios that are going to increase that liquidity depending on your membership profile. So I think it's our job to continue to show that transparently and show that we can withstand any scenario, because rightly so, the regulator has to think about the broader systemic risks.
I did put that to Joe Longo this morning, but I didn't get it. It's okay. It's all right. John, how do you read what the regulator is doing, and how do you read the transparency and liquidity and valuation issues or not in private markets?
I obviously don't have the same concerns as the regulator. I can totally understand where the Commissioner was coming from this morning. Clearly, when something is growing, it's so big, it's incumbent upon any regulator to understand, to get on top of the data, understand what is driving the flows. There are two key reasons, by the way, why do we have the rise in private markets? Two key reasons. Why do companies stay private for longer? Because they've got access to capital. Why have they got access to capital? Because we keep on giving it to them. Why do we keep giving it to them? Well, firstly, you can genuinely take longer term positionings in these assets. Classic example for us is Sydney Airport. When we went from public to private, we can, these days we can take much longer term decisions on what we do with Sydney Airport. The other is a bit more cynical answer, and we call it volatility laundering. Okay, once you take something from public to private, you don't have the mark-to-market volatility, and for our retired members, they don't like volatility. Volatility hurts them. Now, in terms of the concerns of the regulator, I can totally understand from a retail investor perspective why they would be concerned. With lack of transparency, lack of price discovery, all those sorts of things. For an institutional investor, we're taking all that into account when we price these assets. We understand opacity, we understand illiquidity, we understand pricing, etc. So these factors are all taken into account when we actually price the asset.
What risk that this will lead to something that interferes with the relationship that you have with private markets?
Well, hopefully nothing, because we're saying there's a decline in public and a rise in private, but we don't want a situation where we try and even that up by putting a bigger burden on private, right? We want to, and to the credit of the Commission this morning, he actually understands that. We're looking at now, and he's working with the ASX to see how we can potentially streamline the public market process, so we actually lower the burden there rather than increasing the burden there on the private side.
Sonia, your thoughts on public-private?
Well, I think a lot of it's been covered. Maybe the only other thing I'd say is transparency as an investor often is actually better in privates than it is in publics. You can actually get better insights, better governance, and you can have board appointments. So, maybe the regulator has less transparency. I feel like often we have, better transparency.
You're spot on, Sonia. And to add to that, in terms of pricing as well, price discovery, there's this sort of feeling, oh, look, because the listed markets gives you price discovery, that price must be right. Well, there's a difference between price and value, right? During COVID, the depths of COVID, airports sank by about 45%, the listed. You find the unlisted actually got marked down maybe between 10 and 15%. It turns out that the unlisted valuation was far closer to the truer value of the asset.
Because the emotion's not there.
Exactly. It's fear is gripping the market. So, price discovery was actually not working. The market wasn't liquid enough to actually generate the proper price discovery.
So is there a sense among the three of you that the concerns of the regulator are more about the regulator's position and the regulator's ability to get accurate data from the private market than it really is about a bigger regulatory question that will affect everyone?
I think
so. Internal
so.
rather than external.
Yeah, and APRA's inquiry is different to ASIC. So APRA's more along the lines of, hey, you guys are getting so big and you've got the same trades on. Is this posing a systemic risk to the system? Once again, I don't believe we are, because to the extent that you are actually booking assets in an unlevered fund, which is what super funds are, and taking it and not in a 10 times geared bank, for example, you're actually reducing the systemic risk in the system. So I'm pretty comfortable, but as I said, I totally understand if I was a regulator. Firstly, I'd really want to make sure that the retail investor is protected, okay, because they are less sophisticated. But from an institutional point of view, I'm pretty comfortable, and I hope it doesn't lead to more unnecessary regulation.
Yes, indeed. I want to talk to you about AI, but before I do that, let's go to a couple of questions from the floor so that we don't run out of time. Your future, your super, has it genuinely improved performance of leading funds, e.g. the panel? Well said, whoever put that question in. Does it constrain funds' ability to innovate or invest for long-term purpose? Vicky.
It's a very good question. I think your future, your super was a test that in some ways was particularly about making sure fees, so we often focus on the investment returns aspect, but I think it was also at targeting that fees were in some cases disproportionately high, and I think in that case that did enable some benchmarking around that, and several funds did change their fees on whether admin or investments. More broadly, it does have some categorisation and benchmarks in there that aren't necessarily picking up new future investments, and the one that has been given feedback to Treasury, who work on that modelling, has been affordable housing, for example. And so some of the benchmarks in there will be looking for a certain return, and there's no particular category around social and affordable housing. So where do you put social and affordable housing as an investment into an index that is the standard market? And so there are some limitations around that, and the Treasury have been very open about seeking the feedback, and I think that does have limitations because you are sort of herding everyone to the norm. And with this world changing before our very eyes, some of the timeframes, how long it will take for payback, development in some of those critical infrastructure projects can take a very long time from a return perspective. And so which asset class and which benchmark do they go under, I don't think is as evolved as it needs to be. And so that is the challenge.
Sonia, are we better with it than without it?
No. I don't think so. Personal view, not corporate view. And why do I say that? I think what it was there to achieve was to get rid of underperforming funds. We all know the logic, and 100% that needed to be done and it needed to be addressed. And this was the tool that helped achieve that. So I think there's definitely some wins there. But I would amplify what Vicky just said, that really what you're doing is creating inefficiency in the system. You're mapping investments to, I won't say quite random benchmarks, but predetermined benchmarks. And then you're creating risk against some benchmarks that aren't actually even investable, and asking funds to manage that risk because it's quite existential. Like if you fail, then you can't be open to new members. So yes, of course it's going to impact innovation. I think we're lucky, and I'm sure there's others that are really fortunate that it was a retrospective benchmark, so you sort of just got the number you got in many ways, and we were lucky we got a good number, and we've been building on that number, and so that gives you capacity to innovate. Some funds weren't that lucky, and I think there, but for the grace of God, could go any of us, because we're all running private equity portfolios. PE tracks to your future, your super benchmark at about a 10% tracking error, which means in any given year, 2/3 of the time it'll be between plus or minus 20. And even when you average that over 10 years, that's a 2% deviation based on just a bad benchmark, really. And so I think this will be a challenge, and to date, no big fund has failed it. But what if one of our $300 billion funds fails? What are we going to do then? So I'm just not sure we're clear on what that second or third bounce of the ball is here, because really what we care about is driving performance. It actually doesn't assess absolute performance. It assesses relative performance to a somewhat random benchmark. And it's creating, I believe, systemic risk. It's pushing us all into the same benchmarks. It's pushing us all into the same trades, which is, again, not what you want as a regulator. You want a really diversified, divergent industry.
John, do you agree?
Totally agree. Unfortunately, I think it's a moot point because I don't sense any appetite to actually overturn the regulations from either side of politics.
But to be maybe more flexible with the baseline measurements, maybe?
I'm not seeing a lot of appetite.
There was a lot of energy around it, but there's, elections and other things coming up, so perhaps we've missed our timing.
All right. Another question, I'm not sure who wants to take this one. How do the super funds assess the climate transition plans of the companies and assets that they invest in? And do those companies need to be 1.5 degrees aligned? Actually, John, I'll start with you on that one.
Look, we've got three criteria, and we focus very much on our top 50 holdings in Australia because they're the ones that we engage with, they can potentially influence, etc. Clearly, we want to see a 2050 net zero ambition. We want to see a shorter term target, and we want to see evidence that you're actually taking some action. So, you'll get 3 ticks if you're doing all that. If you're not doing all of those, you'll get a stern letter from myself, and we'll have it's the basis of further engagement.
Mm-hmm. Do you want to tell?
Yeah. Oh, go, Sonia.
Similar, and we are seeking companies to be Paris aligned. I think what's the really exciting thing is with ASFI, we're going to have sector pathways, and I think we've been manually overlaying sector pathways at the moment. With each individually. I think it's going to be wonderful to have an agreed sector pathway for some of those hard to abate industries, and also an acknowledgement that some industries will need to move faster. So I think that will give us all a better pathway to keep building alignment around.
Yeah, and I just make the additional comment, again, previously we were talking about just transition, and the important thing is for us to assess the behaviours of those companies, and to John's point, the evidence that you are seeing, and sector pathways will help us with those challenging pieces, but it's not just what people put out on their ASX report and the plans. We need to see the robustness that those plans have investable money behind it and have a true pathway that they are taking. So from my perspective, it is as much of a checklist and working with those companies on that transition pathway, but it's also about the behaviours, the culture, the directors, the governance, and assessing those aspects where you think they will be true to form as such.
That goes very, links in with this question. When you're considering which listed companies and markets to invest in, what comes first, returns or governance? And at what point do you divest? It's an interesting question.
Well, you have to say both, don't you?
What if they don't align?
Well, you have to work with the companies, in my view, to put forward the investors and as stewards of capital the requirements. But businesses do make missteps and do, unless there are checks and organisations like AXI and investors and institutional investors sending a letter like John might, then that can become unchecked. So we have to stay close and aligned, but they won't always coincide.
So it goes back to my comment about Australian super selling out of WiseTech. At what point, regardless, and this actually wasn't a return situation clearly because the stock has gone down, but at what point do you make the decision that you put you have to put the governance ahead of the values?
Well, firstly, in terms of getting into an investment, we're not going to knowingly go into an investment where we think that there's a big red flag over governance, right? So
regardless of
returns.
returns.
in a sense where that's an initial screen. I'm talking about our big investments. There's a lot of little investments. We're a big fund, so a lot of little investments get through where you're not screening everything to the last decimal point. Look, it's just it really varies in terms of at what point you exit. There's so many variables involved. I will say with founder-led companies, you've got to accept that there's a box called G, and that box is never going to have a 10 out of 10 in it. Right? That's you are going in, eyes wide open. That's the case with founder-led companies, and WiseTech is not the only example of poor governance.
Actually, if I can ask you, Sonia, the next question, you're all going to love me for giving you this one. Superannuation remains a contested and politicised area of public policy. How important is policy stability to areas like preservation to you as investors? I guess in some ways that's almost a Dorothy Dixer, but if you can put that in the context of the current political environment when there are a number of politicians who have got different ideas about where superannuation might be used.
Yeah, look, preservation is a core tenet of our system. It's part of what's made it so successful, and it is part of what allows us to generate the strong long-term performance that helps our members retire with dignity. Policy certainty, even more broadly, goes to the trust in the system. So I think when, and we've seen this over years, when there's been constant sort of changes and meddling in the rules of superannuation, the taxation of superannuation, access to it, the age of release, etc., all of those things start to undermine people's confidence in making voluntary contributions. But yet we want to encourage voluntary contributions because it helps us manage and helps Australians manage intergenerational inequity. And so, yeah, look, I think everybody's aware of the issues and the challenges. It's just sometimes it feels like an area that maybe just flies under the radar.
Vicky, can I ask you about AI? And again, it's been talked about today. We had a terrific session, AI being described as a parasite, the ultimate question being whether it fundamentally ends up killing its host. But how do you see AI, twin aspects, implications for investment strategies, implications for business model?
I'm positively predisposed to AI on a personal level, but it's so unknown and the risks around it are substantive. But I'll start with an investment lens first. It is going to be core to transitioning our world, and we are seeing it change before our eyes. So from an investment perspective, as I said earlier, we've already allocated $1 billion. We partner with Quinbrook, and they are building AI centres north of Brisbane, and those AI centres are looking to be renewable, so they're located near the electricity grid so that they can be part of the internet superhighway and be effectively renewable energy 24/7. Now that is an amazing thing, and that superbus is coming. So it is, from an investment perspective, really important. And if we go back to my original point of being about stewards of our members' money, it is really important. It's already happening. So how do we play a really strong role in that? That would be my first comment. My second comment would be, we all know the social risks in AI, and in our investment companies, we have a few good examples. So, that bias that is perpetuated around stereotypes in AI is a real concern. And within our investment portfolio, there are a couple of companies that are doing really interesting things that I'm sure everyone's across. But one of the examples I just want to use is a group called Gilead Sciences, who are biopharmaceutical. And they have gone about using deliberately data sets that are a fair representation of the underrepresented. So they are putting in different data to their own AI so that their AI algorithms can have consideration around biases. Because you can imagine if AI is just based on all the previous history's data of the world, then it loads in all the bias that's been there forevermore. And so there are companies starting to do really good things like that. We know Microsoft has a responsible AI standard, so, big company, but they are thinking about it in that way. So I think there are companies getting, I won't say ahead of it, but really thinking deeply about that. And that's what we're going to have to see. It's a bit like how we started the climate journey maybe 10 years ago. We're starting to see companies get more to the forefront of how will they balance these issues and get ahead of it.
And John, is that the challenge? So you've got you're all invested in the tech, so the people who are helping to build the AI models and provide the generative ability. But isn't the next really hard thing for you is who's actually going to make money?
The downstream. Yeah, absolutely. And that expression, technology, the impact of technology is always overestimated in the short term and underestimated in the long term. And we already know the impacts in the short term, the NVIDIAs, the hyperscalers of the world. Just on that, by the way, everyone sees this DeepSeek as a big threat, etc. I think it's a really positive development, in terms of the hyperscalers, because I reckon it will force them to actually scale back on their investment, their plans, and we were all worried about return on investment. So I actually think it's a positive. By the way, it's an absolute game changer in China. I've just been to Asia. All the Chinese SOEs are incorporating DeepSeek in their business. It's a really, really big deal. You're right. In terms of the, what's really exciting about this is productivity benefits, because where was the next big leap in productivity going to come from? We've been in declining productivity, well, pretty much most of the world, US a bit of an exception, for the last couple of decades. Where's the next big thing going to come from? It's going to be something like AI. And there's great examples already where 20% improvement in productivity, something like quality control in your supply chains, etc. already. But the big gains are going to come much longer down the track, because to get the big gains, you have to fundamentally change the way you do business. You can't just plonk on a new piece of software to your current ways of doing business. You have to rethink the ways you do business. And picking the winners there is going to be far more difficult.
And just on that productivity, though, it's going to be productivity of the business, not necessarily productivity of the worker, isn't it?
Oh, no, it'll be productivity of the worker. It'll be just different workers.
Fair point. It's a whole other discussion. Yeah. Sonia, how do you see AI? And the one thing, the governance issues around it too.
Yeah. Look, I think it's incredibly exciting. It is a bit of a game changer, and I think to your point, we're really only just starting to see the benefits. I think these will really become clearer over the coming decades. And I think for our processes, I think we're all playing with the software, we're all using the obvious applications, but I think that real sort of process re-engineering around AI is yet to come. The governance side is really concerning. I think we all know the challenges, and we're all engaging on these these opportunities for global standards around what could good AI governance look like. How do we make sure there's always a human in the loop? How do we make sure that people are disclosing red lines about what they will and won't do? How are we making sure there's kill switches? So again, I think that's all being thought through, but it's just going to take time to get true alignment on those things. And we saw
were hearing earlier, chances of global standards are slim.
We saw JB Vance, right, saying we need to just take the constraints off and let AI innovate. That's not probably where Europe was when he said that, and I don't think it's where Australia is. So look, I think there will be ongoing challenges, and we've also seen some of the ongoing issues with democracy that AI is potentially contributing to, and the polarisation that is occurring because of social media and these algorithms. So look, I think there's a lot yet to play out, but broadly, incredibly exciting from a productivity perspective. But there will be dislocation that we need to navigate.
It constantly blows my mind in an election campaign that a completely false AI-generated video of a politician saying something is perfectly legal. It doesn't have to, there is no truth in advertising when it comes to politically AI-driven advertising. We are out of time, but I do just want to finish by asking each of you to leave the room with a final observation, if you like, about what maybe we need to be focusing on. I don't know whether it's just sort of holding your breath and staying calm, but what it should be. Vicky?
I guess going back to where I started, let's ignore the noise around ESG and getting caught up in the semantics and will the US do X and Y. I think companies are already changing, and we should just continue the path on staying focused on transitioning the world and embracing the new world that's coming.
Sonia?
Yeah, agree. I think we're here for the long game, and it may be a bit of a volatile ride, but I think navigating that uncertainty in a really proactive and strategic way will drive performance.
Yep. History belongs to the optimists. You've got to stay optimistic.
Stay optimistic. Thank you very much to my panel, and please join me in thanking them for their insights, John and Sonia and Vicky.